Good evening. I'm Mark Bunting. This is the Market Call. We've got Jeffrey Olin, President and CEO of Vision Capital Corporation. He's talking about Canadian real estate investment trusts and real estate operating corporations. Good evening. I'm Mark Bunting, and welcome to Market Call tonight. Thanks a lot for joining us tonight. If you want to get in contact with us, you can call us toll-free at 1-855-326-6266, or you can send an email at marketcall@bnn.ca. Nice to see you, Jeffrey.
Thanks for having me.
So let's remind the viewers what exactly you do and what your focus is.
Vision Capital Corporation manages 3 funds, all of which have a focus on the real estate sector. We focus on publicly traded securities, both equity and debt. We operate long and short. We can and do selectively take concentrated positions in our best ideas. And we seek to be active investors where appropriate, to marry our real estate expertise with our capital market experience to add value where appropriate to our investee companies.
All right, so let's toot your horn here. The Vision Opportunity Fund, inception date was July 2nd, 2008. The return since then, 108%. That is versus the Scotia Hedge Fund Index, which is up 17%. The S&P TSX Composite up 3.5 over that period. And the S&P TSX Cap Real Estate Index up by 21%. So you're 5 times better than the real estate index, the Cap Real Estate Index. How did you pull that off?
Well, my partner, Frank Mayer, who was a top-ranked analyst for over 35 years, and myself bring over 60 years of experience to the space. We look at opportunities earlier. We think we're perceptive. We know the asset class. We know the management teams. We know their properties. And so as situations evolve in different regions in the country and in different real estate asset classes, we can move quickly and we can move effectively. And we've structured our fund in order to be able to take a longer-term outlook as opposed to relying on fast trading and very short-term thinking.
What does the Canadian real estate market look like to you right now?
The fundamentals are sound. The macroeconomic environment is strong. We've had jobs levels, which is good for the economy generally, and real estate markets in particular. Job levels, as you know, have rebounded past to where they were before the recession, and the fundamentals of the real estate markets are sound. We have supply and demand in balance. We have single-digit vacancy rates. We've had limited new supply. We've seen the move from many of the U.S. retailers into the Canadian market, which bodes well for the retail sector as well as the consumer. And so the fundamentals are sound.
Now, you mentioned the U.S. real estate companies or retail companies. You're looking at Target and Kohl's and J. Crew and more Victoria's Secrets. And what does that trend say to you right now?
Well, I think they recognize that Canada is the closest thing to the 53rd state. Canada is under-retailed, and if you look at square footage per capita as compared to the United States, and they recognize that the Canadian economy is in good shape, certainly relative to the United States, and so I think it bodes well. It bodes well for the Canadian dollar also.
Now, the market fundamentals are good, so you say. What about companies themselves? They went through 08 and 09 and seem to fare pretty well compared to other companies. What's the status of real estate investment trusts and operating companies right now?
Again, they're in good shape. Their balance sheets are in good shape. They're not over-leveraged. The real estate executives and the banks have long memories of what happened in the 1990s, and so they haven't over-levered themselves. We're seeing this year, I think you're going to start to see improvements in cash flow. Again, generally in most asset classes, in most regions of the country, the real estate REITs and operating companies are in pretty solid shape.
All right, Jeffrey, we will start taking calls and emails for you right after this break. Jeffrey Olin with Vision Capital is talking about real estate investment trusts and real estate operating companies for you tonight. And we'll start taking your questions after this. Let's start with Jack, who's in Winnipeg. Good evening, sir.
Hi. I have a position in Temple REIT. I bought it before they cut their distribution, and then I bought some more to sort of average down. I was just wondering how you felt about staying in it for the longer term, let's say 2, 3, 4, 5 years. Thank you.
You're welcome. Temple REIT is a REIT that we know quite well. They are in the hotel sector with a significant concentration of their properties in Fort McMurray. So it's a high-risk, high-reward situation. It's very highly leveraged to Fort McMurray and some other markets in Alberta. So if you're very bullish on those markets, it's a good place to be. But like anything that's concentrated both in an asset class and in a region, there's some risk there. We have owned it in the past. We own a little bit of their debt. And so it's if you're in for a potentially volatile situation, it's not a bad place to be. You might see some good returns, and I think that the performance there is improving with the strength in Fort McMac and the oil sands.
When do you choose to buy into a company's debt, and why?
Certainly in late 2008, we were buying a lot of debt because we were getting equity-like returns with a lot less risk. When we see a reasonable current yield but upside, we're looking at total return. So right now we're not buying a lot of debt, but the debt we currently hold, we bought at discounts to par value, and we're getting very solid returns from that debt with obviously a lot less risk.
All right, Jeffrey, up next is Ted in Agassiz, BC. Go ahead, Ted.
Oh, hi, Mark. Always good to be on here. And, Jeffrey, I'm really interested in REITs. We're looking at Northwest Healthcare, heavy in Alberta and other places in the Northwest.
Northwest Healthcare REIT is focused on medical office buildings. It's a unique asset class, certainly amongst Canadian REITs. It was an IPO last year. It's done quite well. It's well managed. We like the space. We have owned it. It's had a good run. I would call it on hold at this juncture. They recently announced a major acquisition in Toronto, a medical professional building on Edwards around University. We've heard there might be some issues in that acquisition, though that hasn't been validated yet. So I think there's some due diligence to be done there. So yeah, I think it's a solid long-term hold, but we call it a hold right now.
And how many companies do you generally hold at any given time? How many REITs, how many operating companies?
We're typically about 15 to 20 of our core positions, and we've had a bias. We own REITs, but we've had a bias to some of the real estate operating corporations, which relatively are showing significant undervaluation.
So you're pretty concentrated then, 15 to 20?
Yes.
Yeah. All right, we'll talk to Larry, who's a regular caller. He's in Toronto. Hi, Larry.
Hi, Mark and Jeff. Thanks for taking the call. I'll make it brief. Invest REIT. It's been bobbing up and down. Globe Investor calls it a strong buy. I have a position in it, and I'd like the speaker's comments. I'll hang up and listen. Good night.
Thanks, Larry.
Thanks for your call, Larry. Invest, again, is focused on the hotel sector. So what you're seeing in the hotel sector, in particular Invest, is they're a leading indicator in terms of the REIT sector of the strengthening of the economy. Their tenants have one-night leases. And so as the economy improves and people start to travel either for business or for pleasure, you see that first impacted in the hotel sector. This is the best quality hotel REIT in Canada. We do own it. We've owned it for some time. We don't have a huge position in it. It presents a reasonably strong yield. They have some great properties in Western Canada. I wouldn't hesitate to hold this REIT at this juncture.
All right, so Jeffrey owns Invest REIT. Thanks for that call, Larry. We'll take more calls and emails after this break. Real estate investment trusts and real estate operating corporations is the topic tonight. More with Jeffrey Olin after this. Let's head off to Montreal. We'll talk to Jack. Hi there.
Hi, how are you there?
Very well. How's it going? Thanks for calling.
Recently, Jeffrey, I switched some of my portfolio into Bonavista and RioCan. Bonavista's taken off, and RioCan I have a lot of confidence in, but it's sure taking longer. What's your opinion? I'll hang up and listen.
Thanks very much. Well, I'm not sure when you bought it, but RioCan has actually had a decent move upwards in the last number of days, particularly after the announcement of Target coming to Canada. RioCan's the granddaddy of Canadian REITs. It's a large cap. It's liquid. It's the number one name Americans look to when they're looking at Canada. We know it well. Outstanding management. They've expanded significantly in the United States. They've gotten higher return properties by doing so. They're the first call that an American retailer will make when coming to Canada because of their market presence. They're a big beneficiary of the Zellers move into Canada because they own a number of them in centres that Target is likely to take them up. We own it, and it's liquid, and it's trading at a decent premium, but it's a name that's always traded at premium and deserves the premium.
Now, we have a call about Target and the impact on Canada's real estate market coming up, so we'll save that for then. For now, we'll talk to Barry, who's in Vancouver. Hi, Barry.
Hi. Thanks for taking my call. Could you tell me how you feel about Canadian Real Estate Investment Trust? That's REF.UN. Has it still got legs, and what's its yield right now, if you don't mind telling me?
I'm looking at, thanks, Barry. I'm looking at 4.35% on Canadian Real Estate Investment Trust.
Yeah, I mean, CREIT is, again, a very high-quality name. Commercial, in the commercial sector, they have office, they have retail. Good properties, well-managed. We don't own it. We've never owned it because it really has enjoyed a significant premium to the sector. So it's not cheap, but it's a very low risk. I think the dividend is solid. They have a low payout ratio, so if you're looking for reliable income, CREIT is a good name to own. But we have found better names to own.
Jeffrey, give us a quick thought on the recent trajectory of REITs. We saw them sort of peak in November, then pull back a little bit. Seems like they're coming back now. Give us a sense of how the various stocks are doing.
Well, the REIT sector, as you say, did very well in 2010, and it's hanging in 2011. I mean, the REITs are the last game in town in terms of the SIFT legislation that eliminated income trusts, so REITs were exempted, so there's been a flow of funds into the REIT sector. And, so some of the valuations are high, but again, our job is to differentiate those that have undervaluation, and so some of them we can be long and we can be short, and some of the names we're short for that factor, but others we think still have compelling opportunities and are undervalued. Right,
and some of those are your top picks tonight you think are deeply discounted to peers, and we'll look at those later on. Let's get back to this Target question. We've got Dave, who's in Toronto. Hi, Dave.
My call, Mark. My question for Jeffrey, and he already touched on it a bit. Aside from RioCan, what other REITs does he feel will benefit the most from Target's entry?
Well, RioCan certainly, and I guess there's a primary and a secondary wave that I would call in terms of the Target benefit, and I'll touch on both aspects for you. Other two names, First Capital Realty and Retrocom, both have significant exposure to Zellers and locations where Target is likely to take up those Zeller locations and create targets. So the benefit certainly is to get a stronger tenant in the first place. The second wave, there's really three waves in our view. The second wave is the benefit to the other retailers in the shopping center that are going to benefit from having a stronger anchor. And really the benefit goes a little more broadly because with the growth, Target is going to be opening new locations. They're going to spend over $1 billion in terms of expansion expenditures. And you're going to see those REITs and companies, both private and public, with strong development capabilities like RioCan, like First Capital, like Smart Centers, Mitch Goldhar that has a strategic relationship with Retrocom, really benefit by being able to create the new space and expansion space and remodel space that Target needs. And so those are some of the names that will really benefit. Primaris also has a number of Zellers. There's some offset in Primaris because they also have a large concentration to Sears, which we think will suffer because of Target coming to Canada.
Now, it's not just Target. In your notes, you mentioned certain U.S. companies are either expanding or entering the market. Kohl's, Marshalls, J.Crew, Victoria's Secret. Is this an area, the commercial real estate sort of mall sector, is that what one of your big focuses now because of these moves?
Well, we've always liked the sector. We have a reasonable exposure to the sector, but we have to, the rental housing market as well, apartment sector as well. But recently on the Target announcement, we did increase our exposure to some of those names.
Interesting. An email now from Bud, who's in Sherwood Park, Alberta, on TransGlobe Apartment REIT, TGA.U in Toronto. Would you have Jeffrey discuss TransGlobe as a long-term investment for 3 to 5 years? What do you think of this one?
We have mixed feelings on TransGlobe. The quality of their apartments, they're in the apartment sector exclusively with a concentration in Toronto. And the quality of their apartments are not what I would call high quality. I wouldn't call them, slumlords either. But they're not as high as, say, a cap rate in Toronto, in our opinion. But they will experience a higher growth because they did an IPO. The private company, TransGlobe, vended properties into the public entity, and it provides a pipeline of further acquisitions. So you're going to see slow, accretive growth in TransGlobe because of the vend-in. But on a long-term basis, they're not the highest quality properties. We suspect there's some deferred maintenance that will have to be dealt with in terms of their pure cash flow considerations.
And Jeffrey, have you personally visited TransGlobe properties, or do you have other people do that for you?
We like to tour real estate. TransGlobe is one you don't have to go far to. You can see their blue awnings all around Toronto. There's no other properties. So we have toured some of their properties, yes.
All right, very good. Back to the phones. We talk to Fred, who's in Calgary. Hi, Fred.
Hello. Yeah, I just wanted to ask your guest a little bit about AX.UN, Artis Real Estate, whether it's a long-term buy or whether I should just hang on to it for the yield. I'll just hang up and listen. Thank you.
Well, recognizing that certain investors require yield, seniors to live off the income stream. Having said that, we think it's a very dangerous proposition to make any any equity investment, particularly based on yield considerations. I mean, when your comment about what happened in the REITs in the fall, I mean, basically in 1 week, the decline in the pricing of wiped out a whole year's worth of yield. So I'd be cautious on any investment being made on a yield basis. Having said that, Artis we like, well-managed, focus on Western Canada, which we like. They've had a significant concentration in the Calgary office, which they've diminished. They've recently acquired some properties in the United States that appear to be compelling. We haven't studied them at length yet. But management are very experienced in their space and in the concentration of their markets. We own it, and it does have a nice yield to it.
All right, Jeffrey, we have a Harold in Vancouver on the line, but we're going to wait to talk to him until after your past picks. And those of you waiting on the phones, we will get to you and your emails as well. But the past picks are impressive. You want to stick around for these after this. Time for Past Picks with Jeffrey Olin from Vision Capital. And now his most recent visit was November 5th of last year. So we'll focus on these ones. Edluin Group, EDU, this is an education company. It's up pretty well 14% since you recommended this one. And you're involved quite closely with this company, correct?
Yes, our funds are the largest shareholder of the company. I sit on the board of directors, and we're quite active on the name. And we assisted them in getting them off the ground in their initial financing in May. This is a company that's in the child care industry in Canada. They're consolidating the industry. Canada is the last Anglo-Saxon country in the planet, really, of any note that has not gone through a consolidation and a professionalism. Edluin has assembled a world-class management team to execute that opportunity. And we bought this with a 2 to 4 year horizon, seeing it similar to some of our earlier successes of consolidation plays, Boardwalk and Killam, that proved to be 5 to 15 times return on investors' money, and we see the same kind of potential. So it's an early stage company. It's got risk as a result, but we see big potential for this name. Is there a reason that the child care market in Canada is so fractured? I think there's a few key reasons. It's a mom-and-pop industry, and what happened over the last 20 years, because these child care centers rely on real estate, the value of the real estate's become expensive. So, for example, in Calgary, where Edluin has its base of operations, if you go to the central city, you'll find a number of child care centers. But you go to some of the newer areas, where there's maybe 5,000 to 6,000 homes, there's no child care because it was expensive to do. And the rule of thumb is you need one child care center for about every 2,000 rooftops. So, and Edluin's opportunity is not only consolidating, but building new state-of-the-art centers to serve that need.
All right, Jeffrey, another past pick of yours on November 5th of last year. Exchange Income Corporation. This one's up a neat 12% since then. What do these guys do?
This was formerly an income trust. They have outstanding management that assemble good businesses. They have us in the specialty airline business, and before people get concerned about airlines, let me say they have a very strong niche, an oligopoly position where they fly to remote areas in Canada to serve the native population that needs to come down to more urban areas to get medical treatment or shop. These areas are served only 6 weeks a year by road, so they rely on this transportation. The government is basically their customer because they pay for this travel. They've done an incredible job, strong management, it has a great yield, a low payout ratio, $1.56. I think there's some prospect of the dividend increasing. They're also in specialty manufacturing, and the manufacturing side, which hurt them 18-24 months, is on a rebound. And I think this is a solid company. I think they have a great pipeline in terms of their track record. People want to do business with these guys, and I think you're going to see big things out of this name.
Jeffrey, your next past pick is also a top pick tonight, so we'll save some information about Retrocom mid-market REIT until later. But maybe you can focus on Mitch Goldhar here, who is keenly involved.
Mitch Goldhar is a Canadian success story. He's the principal of Smart Centers, basically the largest power center owner, manager, developer in Canada. He's the major shareholder of Callaway REIT and a major shareholder of Retrocom. And Mitch is the guy that brought Walmart to Canada out of sheer persistence and tenacity and seeing the opportunity. Mitch adds a lot of value to a lot of these names just due to his development skill, his point of influence in amongst the retail tenants in Canada.
All right, and more on Retrocom mid-market REIT later on from Jeffrey. It's a top pick, as mentioned. So, Edluin Group, Exchange Income Corporation, and Retrocom, the past picks, and the returns very nice, 14%, 12%, and 7.5%. And just lastly here, before we take a quick break, Power Center, as opposed to Shopping Center, those are open air, correct? Where you have a bunch of big box stores? And
yes, exactly. Big box stores, open air, as opposed to enclosed malls, and bigger than a community shopping center that might have a grocery store and a pharmacy anchor and a bunch of specialties.
Just so we're clear on the terminology. All right, Jeffrey, we'll get your top picks later on in the show, about 10 to 8 Eastern Time. More calls and emails from you. We know you're waiting. Be patient. We'll get to you in just a second. There's the toll-free number and the email address as well if you want to contact us. We'll be back with Jeffrey Olin after this. We are back with Market Call tonight. Jeffrey Olin is the guest. You might be wondering, why do you want to stick around for the next half hour? Well, maybe this will pique your interest. The Vision Opportunity Fund, which Jeffrey runs along with his partner, its inception date was July 2nd of 2008. Since then, it's up 108%. Compare that to the S&P TSX Composite, up 3.5%, and the S&P TSX Cap Real Estate Index, up 21%. So very impressive, and that will certainly keep people sticking around. Also, it was the best performing fund in the Scotia Hedge Fund Index last year. And you won, this is the last time I'll kiss you here, I'll kiss your butt, so to speak, top 5 best new funds in Canada last year and the previous year, correct?
Indeed, and I would note of the top 5 funds, we're the only one that didn't use leverage to enhance its returns.
Interesting, impressive. Let's move along. We'll talk to Harold, who's in Vancouver. Hi, Harold.
Good evening. What can you tell me about Common R REIT and its yield? And is it a buy, hold, or sell for the long term, the next 2 or 3 years? Thanks very much.
Well, as a long-term investment, I'd be very comfortable sleeping at night with Common R. They're basically, it could be called Quebec REIT. They're the dominant player in Quebec real estate. The yield is solid, well-managed, significant influence in the Quebec marketplace. I don't think you're going to see any extraordinary growth out of Common R because it's large, because it is heavily concentrated in Quebec, so there's only so much growth they can enjoy, but no issue in holding this for a 2 to 3 year period.
Are there certain REITs in Canada that may be underutilized, certain regions, say Quebec? I mean, what's RioCan's exposure in Quebec, for example?
RioCan's across the country.
Yeah.
absolutely, and in the United States.
All right, so bad example. But are there REITs that you look at and think, geez, they really should try to branch out regionally? They could be more effective in certain areas.
Well, we don't necessarily encourage or seek investments that diverge into regions that they're not comfortable. In fact, if you have a point of presence and influence in a market, that's a good thing. So we often look at REITs or real estate operating companies that are concentrated in certain markets and have a competitive advantage in those markets. And certainly Cominar has a competitive advantage in Quebec. And Cominar is not seeking to try to play in BC and Alberta.
Right, and so they stick to their knitting, and you like that, right?
Yes, we do.
Okay, we'll move along. We'll talk to Jerry, who's in Barrie, Ontario. Hi there, Jerry.
Hi, guys. Great show. I'd just like to get Jeffrey's thoughts on Brookfield Real Estate Services, which I hold, and Brookfield Properties, which I'm considering. Thanks very much.
Well, very different animals. We're certainly more familiar with Brookfield Properties. Brookfield Real Estate Services is essentially the old Royal LePage. So its leverage is towards the what's going to happen in the housing market, the real estate brokerage community with a focus on the residential area. So we don't know it real well, so I'll restrict my comments and focus on Brookfield Properties. I mean, Brookfield Properties is certainly the highest quality real estate name in Canada, in fact, in North America, and amongst the best on the planet. I mean, Bruce Flatt and his team there are, outstanding. They have a significant concentration in their net operating income to New York City, Manhattan. I believe the number is about 40-45% of their net operating income comes from Class A office buildings in New York. They own Class A office buildings and are focused on that in both Canada and the United States. And so if you feel strongly that New York City is going to benefit, it's a great place to be. And on a long-term basis, this is a good name. And we don't own it at the moment, but we have owned it and wouldn't hesitate to hold this name.
A little too rich for you right now, or you like other things, or why don't you?
Yeah, we think the opportunities in Canada are compelling, and Brookfield has significant exposure to the United States. Things are a lot better up here than they are south of the border.
What about Brookfield Office Properties? Do you like that one?
Again, very high quality focus in Canada, sort of the comparison to Brookfield in the United States. But again, it's fully valued, and so we don't own it here.
Now we will take a call from Richard. He is in Vancouver. What do you have to ask about tonight, Richard? Go ahead.
Yeah, thank you for the informative show. Pure industrial real estate.
Yeah, Pure Industrial REIT is focused, as in the name, on the industrial space. So you talked about specialization in regions. Here's a REIT that's specialized by asset class, which is another thing we look for. People that know what they're doing in a specific region or asset class. And these folks know what they're doing in the industrial space. We think that with the improvement in manufacturing in Canada, industrial had been taking on the chin. The industrial real estate class looks to us like it's rebounding. And so we have a position in Pure. We've increased our position. They have a reasonable yield, and I think we'll have some decent growth. And so, again, we look for total return, yield, and capital gains, and we think we'll see some of that potential in Pure.
I just want to shift gears a little bit, Jeffrey. Maybe you can give us some investing advice. Let's say there's an investor who has some knowledge of the real estate sector, but not much, or maybe has a fair amount of knowledge. How do you go about researching your company? What kind of advice can you give as far as how you research a REIT or an operating company involved in real estate, and what makes it compelling for you?
Well, the first thing is to remember it's real estate. It's not yield. I don't know any business that any of us valued in our careers where we looked at how much somebody was paying out of their cash flow as opposed to what is the cash flow. So you've got to be cautious of the yield, and we think there's a distortion in the market today with an excess focus on yield. So what we look at primarily is the net asset value of the bricks and sticks underlying the share price. And is the REIT pricing, or the real estate operating company pricing, because we have a lot of real estate operating corporations, higher or lower than the value of the underlying real estate? Then we look at the growth prospects. Again, for the asset class, Are they in office, retail, apartments? What do we think about that asset class and what regions? Because Canada, as you know, is a diverse country of different economic drivers in different regions, and what's happening in Calgary may be very different than what's been happening in Montreal or Halifax and Vancouver. So those are some of the factors we look at.
All right, very good. Let's talk to Lisa, who's in Toronto. Go ahead, Lisa.
Hi, thank you for taking my call. I'd like to ask the guest what he thinks about the REIT area, since I'm primarily interested in yield and I was very well invested in income trust. I have to look into the REIT area now. I'm currently holding Callaway, and I'm looking at investing at H&R REIT. I would like to have the opinion. I'll hang up and listen. Thank you.
Thanks, Lisa.
Well, again, just at the risk of being repetitive, I wouldn't buy any REIT exclusively for the yield, because you might get your yield, but you might have a capital loss at the same time if you haven't done your homework. Having said that, H&R, again, a large cap, so it enjoys substantial liquidity. We don't own it. We think it's had a good run. Strong management at the helm. They're not the most aligned because it's externally managed REIT, something we don't like to see. We prefer to see internally managed REITs where there's pure alignment of interests, and so we don't own it. But it's a high-quality REIT. I think you're going to see an increase in the distribution. So if you're looking for yield, H&R is one where you can not only rely on the current yield, but you're probably going to see a bump in the yield as they get through to development in Calgary of the Bow, the largest office building in Calgary, which they're building for Encana.
Right.
And when some of the financing and that comes on stream, I think you're going to see a bump in the distribution on H&R.
H&R's yield right now is 4.5%, but the last 5 years they haven't been growing it. It's actually been falling. All right, so that's your recommendation there. But the fact that it's externally managed, is that maybe the key reason why you don't own it?
It's one of the reasons. Mm-hmm. The more fundamental reason would be on valuation. We've owned it despite the fact it's externally managed in the past. The reason that as you say, the yield has gone down is because, this was the most conservative REIT concept in Canada. Long-term leases matched by long-term mortgages. And then they were building the tallest building in Calgary for Encana. Everything was perfect, 100% leased to Encana, A-rated tenant, 25-year lease, fixed price construction. What could go wrong? Well, the credit crisis came, and they forgot to lock in their construction financing. So they needed to cut their distribution in order to save the capital to fund that. But once that development comes on stream, this REIT it's already back in the good graces. Right. But you're going to see an improvement in the yield there.
All right, Jeffrey, a short break. More with Jeffrey Olin, answering your questions on Canadian real estate investment trusts and on Canadian real estate operating companies. A reminder to visit BNN.ca for all your business needs. We'll be back shortly. Let's look at an email now from Ken, who's in Calgary. This is on Boardwalk, BEI.U in Toronto. To what extent should I be concerned about yield investments, such as REITs, when interest rates rise? Boardwalk REIT, for example. This, of course, is a big question when you look at bonds, when you look at REITs. What do you think about interest rates? I mean, based on the Bank of Canada today, they're not going up anytime soon, and they probably won't go up that rapidly, but you never know.
I mean, when you're looking at interest rates and the impact of real estate, you really have to get a little bit deeper and understand why are interest rates going up. Are interest rates going up because there's a credit crunch? That's bad for real estate. Are interest rates going up because it's inflationary times? That's good for real estate because real estate's a hard asset, and so to the extent that the replacement cost of that hard asset is going up because of inflation, that's good for real estate. Are interest rates going up because the economy is strong? Well, if the economy is strong, it probably means tenants are leasing more space and rental rates are going up. So it's hard in a vacuum to make a comment about interest rates. I think BMO Capital Markets about 6 months ago did a bit of an analysis on that regression, and they certainly showed there was some relationship, but it's not unequivocal as people's perception is. So we're not here to forecast interest rates. The thing to understand about these real estate companies, they finance for the long term. So you have to look at what is the weighted average term of their debt. And if they have longer-term debt in place, the fact that interest rates may go up or down may not be an advantage or a disadvantage in the REITs in the short term. Their cash flow may be very strong and intact, and they have strong balance sheets today with good coverage ratios. So I think that the Canadian REITs certainly are well positioned for an increase in real estate companies of increase in interest rates. Boardwalk specifically, again, the largest residential REIT in Canada. We've known them for a long time. My partner and myself were instrumental in their growth at the early stages. In fact, meeting with the CEO today, who owns a lot of shares, which is what we like, alignment, focus and concentration in Western Canada, which we think is rebounding. Calgary has suffered. There was a fair degree of tenant incentives being paid in order to attract and retain tenants. That is coming off. If you have a long-term horizon, this is managed with a long-term view by Sam Colis and his management team. Again, you can sleep at night with this name. It has a low yield but a low payout ratio, and they have a lot of cash on their balance sheet, and the market speculates what they're going to do with that cash. But if you net out the cash, again, it's a reasonable value.
Okay, Jeffrey, detailed answers there on interest rates and Boardwalk. We'll get another one here. This is from Faith in Deep River, Ontario. Hi, Faith.
Thanks for taking my call. I'd like to ask, how good are REITs as a hedge against inflation or even hyperinflation?
Again, just touch on that, but at the risk of being repetitive, strong hedges against inflation. Real estate generally has been an asset class that benefits in an inflationary environment, because if you want to go and replace that apartment building or replace that office building or replace that shopping center, and you're doing so in an inflationary environment, it's going to cost you more to build it than it did 15, 20 years ago when it was previously built. So generally, real estate is a good hedge against inflation.
Faith used the term hyperinflation, which we see thrown around every now and then in relation to the money printing that we're seeing from central banks. Are you anywhere in that camp? It's difficult to predict, obviously.
Well, hyperinflation is not good for anything in economy, so it's not going to be good for, it's going to create a great deal of volatility. I mean, I don't want to get me going on what's going in the U.S., but I think the economic policy in the U.S. is a disaster. And in fact, I heard a good line from, I mentioned Sam Colis. He said, what's happening with QE2 is it's working to create jobs in China, which was quite amusing. So, and those Chinese is working to create, demand for car buying in China, which in turn is good for Canada because they need to come to Canada for oil and gas and natural resources to fuel China. So, what's happening in the United States isn't a pretty picture. And
you think it's a disaster, but does it affect your investing strategy?
Well, yeah, it does. And I mean, we're cautious. We think the Canadian real estate landscape is a lot stronger in the United States. So we have flexibility to invest in the United States and other places in the world. And we've been cautious about the United States. In fact, we've been short in the United States selectively relative to Canada.
All right, Jeffrey, another short break here. We'll be back with Jeffrey Olin. A few more calls and emails on real estate investment trusts and real estate operating companies after this. Peter's on the line in Oakville, Ontario. Hi, Peter.
Hi, thanks for taking my call. I'm new to REITs, and I recently bought some First Capital and thinking of buying some Callaway. Now, some of your guests in the past that I listened to said Callaway and First Capital are some of the REITs you can buy and forget about it because they are well run. Does your guest agree with that on First Capital and Callaway? And I listened to his comment. Thank you.
Well, more than any other sector, the Canadian retail sector and the public markets are blessed with some outstanding companies and management teams, and First Capital is second to none. Firstly, it's not a REIT, it's a corporation, just as a point of information. Very high-quality properties, outstanding management team, big beneficiary of Target coming to Canada because they have a number of Zellers, and they have outstanding development capabilities within the organization that heretofore, while they've used them and used them successfully, I think the current landscape and with some of the retailers coming in, they will be able to leverage that expertise more than they have in the past. We own it. They've delevered. It's conservative. They take a long-term view in terms of real estate. Outstanding, well-located in major urban centers. They're not in secondary markets. So as a long-term investment, we own it. I've owned it personally for many years. A very high-quality name.
Okay, a big thumbs up from Jeffrey on First Capital. Now we'll talk to Dick, who's in Prince George. BC. Hi, Dick.
Hi, thanks for taking the call. I would like your opinion on Canadian Apartment REIT. I took a position as an alternative to adding to an existing position in First Capital REIT or Brookfield Properties, and wonder if I made the right move. Thanks.
Well, very different investments certainly than the other two you mentioned. CapREIT is focused exclusively in the apartment sector. They have a heavy concentration in the highest quality in the public market, certainly of apartments in Toronto. So you need to have a view on whether you think that's a good thing or a bad thing, having exposure to the apartment market in Toronto. They managed through the credit crisis extremely well with the advantage of having access to CMHC guaranteed mortgage debt. But rather than issuing a lot of equity that would prove to be dilutive in the long term, Tom Schwartz, who is an outstanding executive, did something very prudent, and that is he sold some properties to deal with exposure and minimize exposure. So it's low risk. They had some deferred capital expenditure issues, which they've really turned their attention to in the last 2 years and doing a good job. And I think really repositioning this REIT to be a performer on a long-term basis. It hasn't enjoyed some of the upturns that some of the other REITs have had, so it's been a bit of a laggard. At the end of the day, it comes down to your view in Toronto apartments. So there's rent controls in this environment, but because of the capital that they've been putting in, they've been able to apply for rent increases higher than the legislation allows.
All right, Jeffrey, your fund in the last 2.5 years or so, the Vision Opportunity Fund, is up 108%. And how does he do it? Well, we'll find out. He picks good stocks, and we'll find out what they are in Top Picks after this. Time now for the top picks from Jeffrey Olin. He's with Vision Capital, and we are looking at Main Street Equity Corporation, MEQ. And this one, you say, is trading at a deep discount to its net asset value.
Absolutely. A unique entity in Canada. They're focused in the apartment sector in mid-market apartments, but they're value creators. This company has grown from under 300 apartments to close to 7,000 since 1998 with net equity of $10 million. They look at beat-up apartments, they go in, they fix them up, they re-tenant them, they refinance them, and they just generate cash flow, and it's been fantastic. We believe that the net asset value is a minimum $20 to $25, perhaps higher. It's trading around $15.50. They suffered from some occupancy weakness a year or so ago. They were at 19%. They're now below 10%. We believe it's going lower in terms of their vacancy rate. And I think the metric is every 1% reduction in the vacancy rate throws in $600,000 in cash flow net of any incentives without any incentives being considered. So we love this name, we love the CEO, and we think there's deep value here.
All right, deep value in Main Street Equity, deep value in Morguard Corporation, you think, as well?
Yeah, this is a larger entity. They actually are the 8th largest real estate entity in Canada based on square footage. I think it's something, net effective ownership in about 18 million square feet of real estate and a diversified. They're also the largest unit holder in Morguard REIT. They own about 45% of Morguard REIT. We believe that this company is trading at 45 to 55% of its net asset value. Very overlooked. Ray Sahi, Canadian entrepreneur success story, owns again half of it. If you back out the units of Morguard REIT from Morguard Corporation, this discount is actually probably closer to 70%. So, for investors who are looking for deep value with a larger entity, this is a beautiful name.
All right, very good. Morguard Corporation. And your other top pick was a past pick, Retrocom Mid-Market REIT, RMM.U in Toronto. And this brings us full circle to the whole target question, and who will that benefit in Canada? You figure this is one of them.
Yeah, we've continued to like it, and that's one of the reasons they only have 5 Zellers, but they're a small entity. So they're actually the largest beneficiary potentially, because they have the Zellers as a percentage of their rent is higher than any other real estate name in Canada. And the question is, how many of those Zellers will become targets? And, our analysis says 3 4, maybe all 5, but certainly 3 or 4. Again, the strategic relationship with Mitch Goldhar at Smart Centers to leverage that development capability and the influence they have with tenants. There's 2 or 3 centers within that portfolio. There's a bunch of lower quality properties in that company, but there's 2 or 3 properties that would probably justify the share price as it sits today. And they have redevelopment opportunities, and they have a new CEO that's from Smart Centers that's going to be able to access and leverage that expertise, and they have a good yield at over 80%.
And Jeffrey, just quickly, 20 seconds on the new CEO. Tell us about him.
Richard Michaeloff, career real estate guy, came from Smart Centers, solid guy, and we think he's going to get the job done in trying to harvest the value within that portfolio.
All right, top picks from Jeffrey Olin, Retrocom Mid-Market REIT. You've got Morguard Corporation and Main Street Equity Corporation. Those first two, Main Street and Morguard, Jeffrey thinks trading at a really deep discount to peers. Great to talk to you tonight.
Thanks for having me.
All right, and we will see you next time. Jeffrey Olin, all about real estate for you tonight. Thanks for tuning in. As always, consult with a qualified financial advisor if you're doing any investing. Do your own research. Join us tomorrow night. Until then, we'll see you next time.